Good evening and welcome, adjudicating committee and guests. My name is Cormac and I'm here today with my colleagues Robert, Aoife, David and Ava to introduce you to Origin Enterprises and why we believe Origin is a great investment. We have analysed Origin, an agri-services provider, which we recommended as a buy. We use DCF and relative valuation models to calculate a target share price of €4.86, up 52% from the current share price of €3.20. Origin finds its roots in the Irish Agricultural Wholesale Society, which was founded in 1897. In 1988, IAWS listed on the Irish Stock Exchange with its main focus on agribusiness. It further developed this business through acquisitions in areas such as fertiliser, seed assembly, animal feed and marine proteins. In 1997, IAWS strategically repositioned itself to focus on convenience lifestyle foods through the acquisition of Cuisine de France, which was generated mainly by cash from the agribusiness. In 2007, IAWS split its two core businesses, Arista, with its main focus on cuisine and convenience lifestyle foods, and Origin Enterprises, with its main focus on agribusiness, with Arista maintaining a 71% shareholding in Origin. I will now pass you on to Robert to take you through where Origin is today.
Thank you, Cormac. Since 2007, the firm has undergone restructuring and a number of acquisitions, most notably the acquisition of an agronomy business in 2008. The structure of the firm is now divided into agri-services and associates and joint ventures. Associates incorporate legacy businesses from IAWS, which are ripe for sale, and Continental, a direct farming business in Eastern Europe. Agri-inputs is the sale of animal feeds and fertilisers in the UK and Ireland, while agronomy is a newer farm consultancy business. Agronomy is defined as the science of soil protection, the science of soil management and crop production. Origin's model is based on a partnership between the farmer and the agronomist, who visits the farm up to 25 times a year, testing their soil and assessing their needs, all of which is backed by extensive research across 40,000 trial plots, something unique to Origin. A prescription is then tailored specific to the farmer's requirements, encompassing all their needs, including seed, fertiliser and crop protection products. Origin then supplies all these inputs to the farmer, the application of which allows farmers to increase yields and in turn profits. Agronomy will be at the core of Origin's future growth. In the short term, we see growth mainly coming from the UK, as recent acquisitions provide both cost and revenue synergies. We also see growth from increased productivity and cross-selling by agronomists. As independent agronomists retire in the UK, Origin will soak up this business as the largest player in the market. There is also room for organic growth, as 45% of cereal acreage in the UK is currently unserviced by agronomists. In the medium term, we see growth mainly coming from Poland, where Origin currently has a 10% market share. Polish farms currently have very low yields and would benefit from agronomy services. However, farming is less commercial here, so we see the growth mainly coming in the next 5 to 10 years as the sector consolidates. In the long term, large cereal producing countries with commercial farming or the potential for it are possible expansion areas, such as Romania and Ukraine. Ava will now take you through agri-inputs.
Thank you, Rob. Origin's agri-inputs division serves as a complementary role to the agronomy business in the form of input prescription delivering. Through its agri-inputs related to yield, quality and output requirements of primary food producers are provided. In Ireland, Origin's agri-input division comprises animal feed ingredients, fertiliser blending and general agri products, while Origin's main focus in the UK is on fertiliser blending. A number of leading market shares are maintained by Origin's agri-inputs division, especially by its UK fertiliser businesses. Also in Ireland, R&H All hold a position as the leading importer and supplier of raw material ingredients to the Irish animal feed and flour milling industries. There are a number of key strengths maintained by Origin's agri-inputs divisions. These include strong cash generative abilities, leading reputations, long-standing relationships and strategic partnerships. Significant expansion opportunities can currently be seen in the UK and Ireland and are expected in Eastern Europe alongside the agronomy business. These should help Origin overcome any significant threats, as later discussed by Cormac. David will now take you through the financial analysis.
Thank you very much, Eva. I will focus on Origin's performance in terms of margins, profitability and cash flow. Origin's margins have remained consistent in recent years with only minor fluctuations. We take a high degree of confidence from this performance in Origin's bottom line, as the dynamics of the company have been changing and they have been operating in a difficult economic climate. From this, we infer that Origin is effectively managing its new acquisitions. Turning to profitability, Origin is yet to fully realise integration and synergy benefits coming from its new acquisitions, something which we expect to see corrected in the coming years. Focusing on pure operations, the return on invested capital increased to 13% in 2011, a positive trend. The return on equity fell in 2010, due partly to poor economic conditions, but largely down to the fact that Origin undertook a significant paying down of its debts. This return on equity increased to 15% in 2011, which serves to us as a further indication that shareholders are now beginning to get a far greater return from the assets in which they have a claim. Origin has traditionally been a cash-strong business. These cash reserves have been depleted in recent years, which is reflective of some very positive trends upon closer inspection. Origin has spent heavily on investing, typically acquiring new agronomy businesses. In terms of financing, Origin has undertaken a significant paying down of its debts. The fact that the company has been purchasing profitable new assets without adding debt is to us a sure sign that shareholder value is being created. If you add to this the stable nature of operational cash flows, will you take a highly optimistic view on the company's future? Something Aoife will now outline for you in terms of our valuation models.
Thanks, Dahi. In order to arrive at our buy recommendation, we completed two valuation techniques, a discounted cash flow and a relative valuation. However, seeing as the results of our relative valuation verify our DCF results, we will mainly focus on the DCF valuation technique. Within this, we also completed a scenario and sensitivity analysis in order to vary our inputted assumptions. Our DCF is the present value of a 10-year forecast horizon of future cash flows. We used the weighted average cost of capital as our discount factor, estimated at 8.51%. We used a three-stage revenue growth model and adjusted our model to account for profit contribution from associates and joint ventures. Finally, we also forecasted a once-off increase in cash flow due to the sale of associates and joint venture company Valio, estimated to be in 2014. The growth rate of our base case analysis was estimated by quantifying future company and industry projections as previously outlined by Ava and Robert. Within Ireland, we see main growth coming from the Common Agricultural Policy Reform and the elimination of milk quotas. In the UK, we see it coming from a mixture of integration benefits, capturing market share and increased cross-selling, while the rest of the world growth mainly stems from expansion opportunities within Poland and the Ukraine. All these factors result in a share price of €4.86, a veritable buy recommendation. Our scenario analysis involved varying the inputs of our base case analysis in an optimistic and pessimistic fashion. Our bull analysis allowed increased revenues and earlier expansion opportunities, while our bear analysis accounted for the possibility of a negative event disrupting future revenues. These yield share prices of 6.01 and 3.83 respectively, thus verifying our current buy recommendation as both lie above current market prices. Our sensitivity analysis allowed for varying both the WACC and terminal value inputs to our model. With respect to WACC, we varied each component of the capital asset pricing model to use the various discount factors. As we can see, the predominant amount of share prices lie above current market prices, thus validating our buy recommendation. Similar results were arrived at with our terminal value estimation, thus further verifying our buy recommendation. Finally, our relative analysis was also completed to verify our DCF results. Once again, the resulting share prices predominantly lie above current market prices, thus verifying our DCF results and thus our buy recommendation. Cormac will now expand on the risk of the investment.
Thank you, Aoife. Most importantly is ownership structure. Arista maintains a 71% shareholding in Origin, and we believe this is one of the primary factors Origin trades at a discount. Weather is a key variable in agriculture which can hinder performance and impact on sales volume. Retention of agronomists is crucial to Origin going forward. However, we believe this is something they have under control, as no agronomist has left the company in the last 2 years. Finally, farmers' uses of agri-inputs is highly dependent on volatile commodity prices. However, as agri-inputs is not a significant future part of Origin's growth, we do not consider this a very pertinent risk. 5 reasons why we recommend buying Origin Enterprises. Origin is ideally located to increase its UK market share through attracting new agronomists and customers. The agricultural landscape of Poland and the Ukraine represents prime target for greater market penetration by Origin's agronomy model. Origin possesses valuable intellectual capital Origin maintains strong cash flows and low debt levels. And finally, Origin offers a farmer